The countdown is on. Everything you need to get the edge at the end of the market day. This is The Close.
Never have market conditions been so loose and so tight at the same time. Live from Studio 2 here at Bloomberg headquarters in New York, I'm Romaine Bostick.
And I'm Alex Steele, and this is the 30th record close so far for this year.
Well, 1 hour until we get there.
There we go. Let's get a check in on where markets stand. The S&P sitting right at a record again. So is the NASDAQ. So is the NASDAQ 100. So outperforming there. And as investors chase the rally, well, so are strategists. You see upgrades from Julian Emmanuel, Evercore ISI, 6,000. You have 5,600 upgraded over at Citi. The same for Goldman Sachs. Those just continue to cycle through. The 10-year yield, though, up by 5 basis points. A week of buying last week, now set off with those higher yields. And the Bloomberg Dollar Index at one point was the highest level so far this year. That's now reversed a little bit as investors continue to chase that equity rally, Romaine.
Yeah, and let's take a look, though, at the bond rally, that 4-day rally that we saw in U.S. Treasuries coming to a really abrupt end today. You had some commentary out of Minneapolis Fed President Neil Kashkari yesterday, Philly Fed President Patrick Harker today, expressing comfort with leaving interest rates as is, suggesting that the recent drop in bond yields may have been a bit overdone.
I see 2 cuts or none for this year is quite possible if the data break one way or another.
And as that bond sell-off nudges yields higher, the stock market rally is resuming, with the S&P potentially setting up for what would be its 30th record high of the year. And even as that index approaches that 5,500 level, some Wall Street strategists, they say the party is far from over. Goldman's David Kostin thinking the S&P can finish out at around 5,600 by the end of the year. And Julian Emmanuel over at Evercore ISI raising his forecast to 6,000. Now, 6,000 on the S&P would imply the biggest 2-year rally going back to the mid-1990s. That's when we had a big U.S. fiscal spending bill and a dot-com bubble really turbocharging financial markets. Now, historical parallels are always fraught, but this week could provide a fresh look at just, well, whether the economy is strong enough to withstand higher for longer rates. You got government reports on home purchases and retail sales, as well as some big earnings out of Darden, CarMax, and Lennar.
All right, let's get back to your last story, the first story here, and talk about what's going on in the bond market. So I talked about the rally that we saw last week, right? Higher prices, yields go lower, and we saw that very much when the Fed meeting took place over on Wednesday. What we've seen here is a tiny bit of a round trip. So if here's the Fed meeting and here is the data, and then you move lower here, and then boom, you see rates kind of moving a little bit higher. You also got a lot of corporate supply, particularly from Home Depot coming on, and that's moving to higher yields as well. We were also kind of in maybe overbought territory, so that's part of the issue as well. Is that just a technical scenario? Are positions right-sized? Or is this more continued of a commentary of that higher for longer scenario and those higher bond yields, Romaine?
Let's kick things off to the close right now with Bruce Richards, co-founder and CEO of Marathon Asset Management. And Bruce, all the talk last week, of course, was about the Fed, what they didn't do, but more importantly, what they're telegraphing in a market. When you look at what's happening in treasuries and you look what's happening in equities right now, that doesn't seem to think the Fed is going to hold rates as high as they seem to say they are.
Well, you could say that, or then you can just listen to what the man had to say at the presser last week when Fed Chairman Powell showed us the dots and shared with us that there would be only one easing this year. It's a very far cry from, 6 that was expected by the market coming into the year. So, yes, the inflation number is getting softer and trending down towards that, 2% goal that everyone wants to see, and that's really good news. But here's the thing that I'm thinking about. If you're Fed Chairman Powell, are you going to ease so quickly when equity markets are all-time highs, job markets are incredibly strong and robust, and the economy is strong? Because if you were to ease, might it just inflate a little bit more the economy, equity markets, and cause these animal spirits to come back and inflation to come back? And so they're going to go, I think, very, very slowly and very, very cautiously. So you might expect 1 ease or 2 eases and then a long pause to see, did it do anything to reinflate inflation?
Yeah, but is all this ends up being academic to a certain extent? Because we keep talking about what the Fed may or may not do. And the question I guess I really have is, does it matter, right, at least in the here and now, for the economy and the markets? I mean, 25 basis points, even 50 basis points of easing. Does that have a material impact?
The U.S. economy is so strong, and the reason why it doesn't have a material impact is because the Fed really doesn't matter. And that's really hard to say. No, they don't really matter, given the amount of fiscal stimulus that's happened. And the fiscal stimulus has been so exorbitant, so huge, never before seen in a growth market like we've had, and yet it came through in trillions and trillions and trillions. I'm talking about Infrastructure Act, the CHIPS Act, and many other acts that added trillions of stimulus at the time the Fed was tightening. So I would say that you're right about that. It is a bit academic because here we are at higher rates and the economy is just fine. You have to stay bullish because the economy is strong, jobs are strong. The stock market, we're going to see what's going to happen with second half earnings, and we're going to have record earnings in the third and fourth quarter. Mm-hmm. So I'd say stay bullish for equities and stay bullish for credit as well, because a higher rate environment that we're seeing is really, really bullish for the bond market.
So let's get to that. Okay, so the higher equity market, economy is really good. What's the bankruptcy situation like? I mean, are we going to see the kind of bankruptcies that everyone was sort of anticipating, or the weakness that we've been anticipating? What do you think?
Well, first of all, I'd start with default rates. Default rates are trending around 4%, and today, about 3/4 of these defaults don't come from bankruptcies, don't come from Chapter 11s. They come from these LME, these liability management exercises, or what the rating agencies refer to as distressed exchanges, where the creditors are crammed down. They have to receive a lower interest payment, less principal, or termed out debt, something that's adverse to them. Private equity is very smart. They're very smart to start with in buying companies, and very smart when it comes to financial engineering. And what they've figured out is it's really costly to put a company in bankruptcy. The business interruption cost, all the legal costs that you go through when a company's in bankruptcy for a year to 2 years. It's much better to extract a pound of flesh from the creditors. And with 90% of the broadly syndicated loan market being covenant light, they can do that quite efficiently by taking assets, moving over to an unrestricted sub, coming up with new money solutions from folks like Marathon, who will give the company, the private equity company, additional dollars, right, to make it through, and at the expense of existing creditors. So what I would say is this is a very favorable environment for the credit markets, because while 90 to 95% of the markets can sustain these higher rates, and you're getting paid the best yields in the generation, those other 5 to 10%, there's also a lot to do for us opportunistic credit managers that are providing capital solutions and these solutions for these distressed exchanges.
Is part of that going to be in commercial real estate? Because we haven't had that disaster that we've been waiting for. Commercial real estate is, again, like the pig through the python. It's a slow process that's being worked through. So commercial real estate debt markets are around $6 trillion. About half of that is held within the banks, and about half of that is in the private credit sector between the REITs and the CMBS markets and so forth. So the good news for commercial real estate is, and there's very good news, is valuations have stabilized. It's a big market, and there's lots of really attractive deals to do. That's the good news. The bad news is that there's about $1 trillion of this debt that's upside down, where there's no equity value left, and the creditors have to work through this process of workout. And so there's a big, huge maturity wall.
I see the advantage of sort of doing these kind of non-bankruptcies, whatever we want to call them, refinancings or recapitalizations, if you will. Are we just kicking the can down the road, or are we actually making these companies healthier and, in theory, more sustainable?
They're more sustainable because in that process, there's going to be less debt, and the cram down itself usually relates to less debt in certain cases. In other cases, you're right, you're just kicking the can down the road and waiting for a day out in the future. But if the companies can then grow into those capital structures, that's a very positive thing. And so quite often with these exercises, they actually can. And sometimes, you're right, they probably can't. And then the bankruptcy waits down the line a year or 2 years, out in the future. But in most cases, these new money solutions have the collateral that protects them. And so they're senior, they're secured, and they have the collateral with the covenants in place. And so it's really a good, attractive way to put out money. And I look across Marathon's book of all these capital solutions we've done, it's across industries, because private equity is invested across industries, and you're seeing this high debt burden not impact just one or two sectors, but really all industries.
All right, Bruce, you're sticking with us. Bruce Richards of Marathon. His views on how politics could impact the market this year. I know, we do. We have to walk to the election in November. This is The Close on Bloomberg.
replacing the income tax with revenue with tariff would be the worst macroeconomic policy proposal in U.S. history.
It was former Treasury Secretary Larry Summers blasting policy ideas floated by former President Donald Trump, which pushes us ahead to the year of elections. And just in the next few weeks, June 27th marks the first presidential debate between Biden and Trump. Then you got the UK election on July 4th and France's two-round of a ballot concluding on July 7th. There's a lot to digest in a very short amount of time. Bruce Richards of Marathon Asset Management is still with us. Bruce, how do you think about the election? How do you think about election risk right now?
Well, look at the election risk we just saw in France, right? Where Macron called for an early election, and he's still going to remain president, but the parliament is up for grabs, and it looks like his party's going to lose a bunch of votes, and votes are going to go to the far right and far left. And what did the stock market vote for? Well, the CAC 40, which is the French stock market, was down 6.2% on that news. And French bonds, which are the OATs, widened out 28 basis points relative to bonds. That's the biggest gap in debt versus, our versus debt markets and equity markets versus our equity markets is up that we've seen in like 15, 20 years. So elections do matter, and we saw that right there, right? And so 6 of the 7 G7 countries are up for election this year. And so it's a big year. You're right. It's the year of the election. Here in the United States, we have a big election. And although we try to stay away from politics, this is going to affect markets in a very big way. So think about several things. Number one, the border itself. That's probably one of the top issues. Mm-hmm. And people don't want to talk about border because it doesn't relate to the economy. Well, yes, it does. The number one driver of employment over the last 3 years has been immigration. You take immigration out, jobs are flat. Mm-hmm. And meanwhile, they've been growing by leaps and bounds, hundreds of thousands a month, month after month for 3 years now. We've had this great employment growth, mm-hmm. and it's because of immigration. So that's one factor. The second factor is regulatory and regulatory capture and everything related to, big government versus kind of pro-business, right? And so when you think about the former president who wanted to take a hands-off approach to business versus the current administration, President Biden and the FTC, which has been kind of anti these big M&A transactions, you'll see a very different outcome. Mm-hmm. The investment bankers and corporate CEOs are probably lining up, if the former president were elected, to announce deals sometime going into next year versus kind of hands-off right now with certain of these companies. And finally, what I'd say is taxes. It's a very different tax stand, right, that President Biden would have versus the former president, mm-hmm. with respect to corporate taxes, as we all know, mm-hmm. and what the implications are there for companies, as well as the impact to higher taxes for the wealthy. So very different policies, right, and a lot on the line.
A lot of people would say very different policies, but when you look at history, at some point it kind of balances itself out, at least from an investment perspective. Is there a point in time in this election cycle where it is appropriate to actually act on the potential for what could happen? Do you wait till after the election? Do you front run it? What do you do?
Well, one of the greatest trades of this last 15, 20 years is when President Obama was elected and knowing his stance on healthcare, mm-hmm. and buying into healthcare companies in advance of him taking office. Mm-hmm. And that had legs that took us from years and years and years on, and is still working to today based upon Obamacare and all the policies and measures that were put in place. So yes, I think these implications of what one administration, our current administration, might take versus the former administration might take is very different, and will have implications for sectors and for companies specifically.
One thing that seems to stay the same in all the research that I read is that the budget deficit, the fiscal deficit, is going to grow. Like, no matter who's in the White House, there's going to be more money in different ways coming in. Do you think that effect? Like, is that true? Do you look at it like that? Is there a long-term bond yield play?
It didn't used to be the case, but now totally. I think it more is the case and what's baked in. And so I wouldn't disagree with that at all. I was, rather disappointed, to see how much the deficit grew during the Republican administration, because I'm all for, fiscal austerity or fiscal strength, and how it's, been relatively indifferent. But what I would say is I think we'd have slightly bigger deficits with the current administration than we would with the former administration, because I think the former administration has learned from that and wants to downsize government and wants to downsize a lot of the benefits that so many folks have enjoyed in these last few years. And I think it actually might be a little greater than what the commentators are stating and versus what you've seen in these last few years.
We only have about 30 seconds left. But on that point, though, are we focusing too much on the president himself? I mean, I think about the elections that we just had overseas. That was less about the man at the top and more about the legislatures or the parliaments. And I wonder if we're going to find ourselves in the same situation here in the U.S., where who's in the White House is going to matter less than what the complexion of Congress is.
Good point. Yeah. Executive order.
Yeah.
Will be the order of the day.
More executive orders?
More executive order than we've ever seen going forward, because that Rubicon has already been crossed.
Okay. All right, Bruce, a great conversation. Always great to have you. Bruce Richards, he's the CEO of Marathon Asset Management. Help us kick you off to the close here on this Monday afternoon. Coming up, we're going to take a closer look at where the market for global commercial real estate is headed. The CEO of JLL, Christian Ulbrich, going to be joining us in just a second.
All right, plus shares of Autodesk soaring after activist investor Starboard Value takes a $500 million stake in the software company. We're going to look at the changes that they're pushing for.
And a closer look at shares of Keurig Dr. Pepper moving higher here on the back of an upgrade over at Truist Securities. We're going to talk to the analyst behind that call. All that and more coming up in a bit. This is The Close on Bloomberg. All right, let's get a view from the sell side with our top calls. The big movers on the back of analyst recommendations. And we start off today with Micron. Analysts over at Susquehanna and Cantor Fitzgerald raising their price targets on the chip maker. Cantor CJ Muse lifting his target to 180 from 150, citing favorable pricing trends for high bandwidth memory and Micron's disciplined approach on the NAND side. Those shares up by about 4.5%, 147.61, a record high. Next up, Toll Brothers. It had 2 sell ratings at the end of last week, has only 1 today. Goldman Sachs upgrading its view to neutral on confidence that revenue, profit, and market returns will hold ahead of historical norms as new home sales and customization trends continue to grow. Those shares up 0.5 percentage point. And let's take a look at Keurig Dr. Pepper, an upgrade to hold from sell over at Truist. Analyst William Chappell says concerned that earnings expectations were too over-optimistic. They've already played out and are reflected in the current valuation. He adds that the new CEO, Tim Cofer, will lead Keurig to more long-term focus investor base. Shares higher up by about 2% here on the day, and those are some of our top calls. Let's stick with that last one there and bring in the analyst behind it. Bill Chappell joining us right now, managing director over at Truist. And Bill, I want to get to this idea here of kind of the long-term outlook for a company that has a new CEO, a CEO with a pretty good pedigree, at least when it comes to the consumer space here. How much of that can really sort of lift this stock?
Especially for a consumer, thanks for having me, especially for a consumer staple name like that, where investors are looking for a steady hand, something they can trust quarter in, quarter out, a manager who is not going to necessarily take them off the deep end, out to the deep end by acquisitions or hyped up forecasts. I think that's what Tim Cofer brings to this company, and that's really will help them be seen more like Pepsi, be seen more like Coca-Cola, and be more of a focus on the Dr. Pepper part versus the Keurig part of Keurig Dr. Pepper.
Yeah, and speaking of which, Dr. Pepper, of course, overtaking Pepsi, Eloisa as the most popular soft drink, second most popular soft drink here in the U.S. Is this going to be primarily viewed as a play on soft drinks, or are some of the other product lines that Keurig Dr. Pepper has been getting into, is that going to be more of a lift? And I'm talking primarily in the coffee segment.
Yeah, you hit it exactly on the point. I mean, as you said, Dr. Pepper overtaken Pepsi is a leading soft drink, yet Keurig Dr. Pepper stocks vastly underperformed both Coke and Pepsi over the past 2 years. And that's because for the hyped up or overexcited expectations for that coffee business. And even though it's only 20% of their total sales, when you put focus on it, investors will focus on it and expect them to outperform. And it hasn't. And it's very simple of Keurig machines are fantastic. If you didn't have one before the pandemic, you probably have one now. But management believed that after we got out of the pandemic, we just get back to normal. They'd add 2-3 million households a year for the foreseeable future and eventually get to 50% household penetration. And our question when we had a sell rating was, how would that happen? We felt like there was really a pull forward of we were locked down at home. We didn't go to work as much. And so even if we didn't use a Keurig machine before, we have one now. And now as we go back to work, we're using those less and less. We're not using them at all. And we didn't see how, after that pull forward, the category would ever really grow again like it did pre-pandemic. And that's where we differed with the prior management. And I think Tim Kofer and the new management kind of understands that. I think investors more understand that we're not going to return to growth for that business. And so if that's steady, we can now focus on the Dr. Pepper side that is growing so fast. It's got great marketing.
So, Bill, if we're going to just really look at that cold beverage part and then the growth there, what about margins and cost control? Are there, especially as the economy may or may not slow here?
Fortunately for them, the commodities, when you look first on the coffee side, the key commodity is green coffee costs. And green coffee costs have come down pretty dramatically over the past 2 years. And so the margins are getting better. And that's why you're actually seeing a little more promotion when you go to the store in coffee. For the rest of the business, the cold beverage business, commodities are down dramatically from kind of that post-COVID surge. And so you're seeing margin expansion. And again, it's not that they aren't operating well in that cold beverage business. Investors just haven't been paying attention to it because of all the noise in the coffee business.
All right, Bill, thanks a lot. We appreciate it, Bill Chappell. We're going to leave it there due to time. Bill Chappell over at Truist joining us there. Recently, though, the stock has still had a pretty solid run just really since the end of April. I'm just trying to do the calculations here. It's had a nice run up since then.
Yeah, it's been doing well. And I think obviously a lot of this is on the back of that hire. I mean, remember they made this announcement last year, and I think that kind of correlated with the bump up that you're seeing in the stock. I know he just took over, whatever was it, like in April or maybe it was May or something. So he's only been there for a couple of months. But you do kind of wonder, like, what is the magic he's going to work here that's going to really separate this company from its previous CEO and some of the mistakes he made.
I mean, it's number 2. I was really surprised when that came out. Beating Pepsi?
Yeah, well, as a Dr. Pepper fan, I was like, finally.
Right.
Everyone always derides me. They say, you drink Dr. Pepper?
And now you're like, yeah, it's number 2, man.
Well,
My daughter just started drinking Coca-Cola. She's like, this is the best thing ever. All right, coming, we're going to get some more insight on the global commercial real estate market with the CEO of JLL. This is The Close.
So the good news for commercial real estate is, and it's very good news, is valuations have stabilized. It's a big market, and there's lots of really attractive deals to do. That's the good news. The bad news is that there's about $1 trillion of this debt that's upside down, where there's no equity value left, and the creditors have to work through this process of workouts.
That was Bruce Richards, the CEO over at Marathon Asset Management, talking about the good news versus bad news in commercial real estate.
Yeah, and we're all kind of all waiting for that shoe to drop, right? Like that big shoe and stuff, but it hasn't actually happened. It feels like it's a rolling sort of shoe. But I talked to a lot of guys in radio, commercial real estate in New York, and they're like, yeah, there are tough spots, but we're doing all right. Yeah. So it's interesting to see kind of where that lies. So we're going to talk to Christian Ulbrich now. He's CEO of JLL. It's one of the largest players in global commercial real estate, trading on the NYSE. It reported first quarter revenue of $5.1 billion, up 9% from a year ago. Christian, I know you do global, so it's a very different story for you than, say, someone maybe focused in New York. But how would you describe the state of commercial real estate right now? Good, bad, or ugly?
It's getting better.
Okay, tell me more. Where is it getting better? Where are the hurdles?
Well, in the US, it's getting better the most. We have seen an uptick across all asset classes in the first quarter. Even office leasing was year over year 14% up in the US, 12% in Asia, and only 8% in Europe. So you see the difference. And we also see that the overall interest in buying commercial real estate is growing. We have a much stronger bidding list when we bring products to market. So we are on a gradual improvement of the market.
So, Christian, when we start to talk about this gradual improvement, we still have to kind of talk about the legacy of what's out there. There are still a lot of issues that have not been resolved, refinancings that still need to be done here. As a percentage basis, though, where would you rank that? Is that a big concern for you right now? Does that fall into a major category, not just of your portfolio at JLL, but your peers as well?
Well, I mean, there is certainly a significant amount of assets which are underwater, where the equity is wiped out and where you have to find new ownership. And so that still has to play through the system. But that will take time. And so far, I would say the lenders have been quite smart. That is not all coming to market at the same time, but we will still see a little bit of hiccups here and there. But overall, we believe that the situation is pretty much under control.
So as some of those things do come to market or potentially fail, in your view, you don't see any real systemic risk as a result?
You know, at the very end of the day, that is a lot of psychological effort, which is also impacting that situation. So if too many bad news are come to the market at the same time, you never know how that will play out. But I'm fairly optimistic that the market will act smartly. We have seen that with the banks who got into trouble, that they were taking out in a very smart way. And there will be probably a couple of more banks which will face issues. But again, I believe that they will be taken out smartly. So overall, I'm not overly concerned that we have a systematic problem to face.
Christian, there are also so many subgroups here, and two that stand out to me are logistics and data centers. So logistics, I felt, were super hot a few years ago, and then other questions as to how many logistic areas do we really need? Are they overvalued, undervalued? And then we have the data center hype. Where do you sit in both of those areas?
Well, as you rightly say, there was a bit of a logistic hype coming through the COVID period, and that has to be digested now. But overall, this is a very strong asset class. With the onshoring and the stronger than expected economy, the market will kind of take up the slight oversupply which we had. And so we believe that the industrial sector, the logistics sector, will come back as on a positive trend relatively swiftly. What we see currently in the data center market is a massive hype. Don't know how long that will take, but at the moment, it's clearly the hottest asset class around.
What form is that taking? Like, what does this cycle potentially look like here?
Well, as you know, the data center market is slightly impacted by the ability to get available grid. And so that hinders the amount of new product coming to market, because many of those products which wish to come to market don't get access to grid. They don't have enough power available. So that can play out over a couple of years, that cycle here, that hype cycle. At the moment, many people are trying to get in, and there's a lack of product. And so we have to see how that whole AI discussion and the need for additional kind of data center capacity will play out over the next couple of years. I'm not in a position to give you an exact prediction here.
Well, you've certainly pushed into it, at least based on what we know publicly over at JLL, not only in terms of the real estate itself, but also some of the services and the software offerings that you've put out there for certain clients. And I am curious about that side of the equation, why you saw a need to do that and what that opportunity is going to mean for the business going forward.
Well, these are two sides. First of all, we have a couple of our own generative AI software products, which we have developed or bought into, and which we are deploying on behalf of our clients to offer a better experience for them, but also to drive higher productivity within our own organization. And then we have that services field where we are offering services around data centers, and that's where we complemented our service offering recently through M&A. As I said, it's a very interesting asset class. All of our clients, or many of our clients, are trying to get into, and that was reason enough for us to broaden our own service capability around that topic.
Do you see yourself expanding that in a meaningful way based on what you can see right now?
Yes, we will continue to expand that, roll that out into other geographies. At the moment, we are very, very strong in the US and in a couple of European and Asian markets, but we still have to expand in a couple of other geographies so that we can give our clients also on the data center side a seamless experience all around the globe.
Christian, as we look to the back half of this year, what region or what asset are you most concerned about?
Well, I mean, clearly at the moment, the offices sector is still under pressure. We will see further value declines for the majority of office buildings. It's only the very, very top end which has stabilized or is even kind of improving already because rents are rising for those buildings. But overall, that asset class is still digesting that massive kind of storm it had to go through. And so we have to be concerned about that probably for another 12 to 18 months. But besides that, I would say all the other asset classes have seen their trough and are gradually improving now, some faster than others.
All right, Christian, appreciate you taking time for us. Christian Ulbrich there, the CEO over at the real estate giant JLL. A closer look here at the commercial property space here with an office sector still on the back foot. But I guess, as he says, Alex, maybe the pain from that will be spread out a little bit so we don't have to worry about some of the systemic issues that maybe we would have gotten.
I mean, because at the end of the day, a bank doesn't want to own an office building.
Yeah.
Right? Like, that's not going to do anything. So restructuring or helping term stuff out is going to be a lot more beneficial, it seems like, to everybody, which ironically is what kind of Bruce was saying, that like bankruptcy is sort of the last resort. It costs too much.
Yeah.
Business goes under. You got to find different ways of managing it now.
Yeah. And I guess my concern, though, is that are we just kind of propping things up? Does this become the zombie company things that we used to talk about a couple of years ago? That was more blamed on the Fed and interest rates. And are we going to get sort of a redux of that? But this time, more just the lenders and the private creditors out there kind of propping these companies up as well.
I don't know. Any of all the money going into private credit? I don't know.
All right, well, coming up here, we're going to talk about some of the big movers here on the day, including Autodesk. After building up a hefty stake in the software company, Starboard Value now filing a lawsuit against it. We're going to get you some details there. It's our stock of the hour, and it's coming up next. This is The Close on Bloomberg. All right, it's time now for our stock of the hour. Taking a closer look at Autodesk, up the most in about a year and a half. This after the activist investor Starboard Value revealed that it has a $500 million stake in the company and that it plans to sue the company to delay its annual meeting so it can get a better shot at board seats. Abigail Doolittle joining us to talk a little bit more about this. The stock, at least when you look at some of the metrics within the company in terms of margins, revenue growth, Starboard making the case here that this company has underperformed, at least relative to its peers here. Explain exactly what they're trying to do.
It's interesting because that is what they're planning on doing in terms of unlocking value. And they've done this with other companies, Salesforce.com, Splunk. In terms of the bigger piece, though, the possible lawsuit, this has to do with perception because this company has something that no company, no investor wants to hear about a company having, and that is an accounting probe. What Starboard is saying is that they disclosed the investigation that basically shows that it had to do with a shift in billing structure to inflate their free cash flow and their operating margins, that they disclosed that about a week after the time when you could nominate new board members. Starboard said that they went over to Autodesk and said, listen, we would really like you to reopen that window so that we could, I don't want to use this language, but clean up the board. Now, ironically, it was the board that said, no, we're just fine, not surprisingly. Yeah. And then this morning, Starboard came out saying that they are going to file a lawsuit to have that window reopened. But Autodesk, the commentary on the terminal is saying that they have a clear strategy, they're confident, they're planning on having the annual shareholder meeting on July 16th, so really not budging. I am not sure if the lawsuit has been filed. I suspect what's happening is there's some negotiations behind the scene where Starboard is really saying to Autodesk, listen, we're serious about this. Let's have a conversation. Let's make this happen.
Aside from the delayed 10K filing and all of the issues that went with that, how does the business fare in terms of its competitors with sales growth or free cash flow margin and competition? Yeah, so I mean, they are. That is the goal of Starboard in terms of the activist position. It's interesting because it's a relatively small position. The growth it's not awful. It's double digit for the top line this year, 11%. For the bottom line, 19%. Next year, they're looking at 84% bottom line growth, which would suggest that the margins are okay. But Starboard also thinks that they can do things beyond the numbers, that they can do better investor communications, buybacks, limit M&A, really clean the company up. Doing all the things. Yes, all the things that an activist investor might do. Okay, Abigail, thanks a lot. Really appreciate it. Abigail Doolittle joining us there. Autodesk shares really spiking on that. Okay, day 30. It is the 30th record high so far this year. Romaine, it looks like we're going to close that way. Yes,
yeah,
up 1%.
Stocks right now, the S&P right now at those record high levels here and at session highs. And we talk about sort of what's really driving these gains here on the day. It's kind of a reassertion of tech, though we are getting probably much more of a broader rally than what we saw in those first few days of last week.
Here's my question. Are we also seeing some safe haven flows maybe out of Europe and into the U.S. after the turmoil last week? Like, is that also part of the story? Doesn't mean that money will stay because we have elections too in November, but is that part of what we've been seeing also?
It'll be interesting to see if that's the case. I think we have to wait a little longer to see those fund flows. Kind of interesting, though, that if they are looking for a safety trade, that's not necessarily going into treasuries or into the dollar itself here. So it'd be interesting that they still want risk. They just don't want European risk.
Yeah. Or last week they liked treasuries and the dollar. Maybe we just today they're like, we'll take a little bit of pause here. But we are looking at the 30th record close for the S&P as we head into the closing bell. You're also continuing to see tech continue to outperform with the NASDAQ up by 1.2%. Coming up, Susan Schmidt is head of public equity over at State of Wisconsin Investment Board. Her take on analysts and strategists really chasing this rally here. This is the close on Bloomberg.
This is the countdown to the close. Romaine Bostick alongside Alex Steele with about 10 minutes until we get to those bells. Stocks right now camped out around session highs, 54.76 right now in the S&P 500.
Record high, record high, record high. But it also is the S&P equal weighted index is also up 0.6 along with the Russell 2000, but definitely underperforming the S&P. The difference between the two of them is somewhere between like 10 and 15% versus the equal weighted and the Russell versus the S&P. That's significant.
Seeing the bond rally flip-flop here on this day, pushing yields higher, up about 6 basis points here on the shorter term 2-year yield. Though we should point out the VIX still under control, under 13. Not really a whole lot going on with the dollar. As we move closer to those closing bells, a good look at that record high here that we are just about 9 minutes away from. Julian Emanuel and his team at Evercore ISI staring down that rally and saying, well, it could go even further, raising their year-end price target to 6,000, the highest among major equity strategists tracked by Bloomberg. Emanuel saying the backdrop of slowing inflation, a Fed intent on cutting rates and growth, that's all supporting Goldilocks. For more, let's get some insights out of Susan Schmidt, head of public equity at the State of Wisconsin Investment Board, joining us here in Studio 2 in New York. All right, Susan, 5,400. We might as well just call it 5,500 at this point because everybody's looking way beyond that. When you start hearing these forecasts for 5,600 or even like what Evercore is looking at 6,000, looking at fundamentals, does that appear attainable to you?
Well, I think people are certainly optimistic rolling forward, right? And so we've adopted this mindset that AI is going to work no matter what. Alex, as you pointed out, there's some definite differentiation in what's working in the market. And if you're big cap, you're in the sweet spot. So big cap AI, that's what people are rewarding. But there is some justification for the valuation on those names. They came out with great earnings reports. We're hearing management teams talk very strongly about the potential for this and what they expect going forward. And I think that's what investors are looking for. There are not a lot of things out there right now in businesses that can talk about multi-year growth trajectories. And that's where investors are rewarding them. And I think investors are really responding to that positively. They want to hear that.
When you look at the outsized gains, though, that have been driven by big tech, and just last week we came off that huge rally in tech. I think it was something like the widest gap in tech versus the rest of the S&P that we had seen going back to 2002. Does that concern you, or are we sort of overplaying that gap too much?
Well, the market always swings too far in either direction. And so I think we are seeing some of those fits and starts. It's never a perfect straight line up. Do we think that this may settle a bit as we go forward over the next couple of months? Remember that we're surging into the summer. People are trying to get positioned. We don't see a lot of activity over those summer months. The volume comes down. So I think that could be part of this move. But I also think that people are generally betting on a theme and thinking that this is where they want to be in the future, and they're comfortable taking those positions and riding it out.
Yeah, we have lots of stuff going on Friday. For example, the rebalancing, we have quad witching, so who knows what the next few days will bring on that. Is there a backdoor AI play? Then?
Absolutely.
Okay.
Absolutely. And we've talked about this before, but I think it still exists. I think actually that backdoor play has come back into focus because we saw the focus come back to the mega caps, the really large caps. But you've got a lot of mid cap players in here who are funneling into this AI trend. So you still got that data center play. What's interesting with the first quarter earnings reports and management commentary that we've heard at those reports and over conferences is that the need for data centers, the need for memory storage, the need for processing, still way underestimated by investors. And so as managements are talking about this, there's a lot more demand there. And that gives them backlogs that they're reporting that are at multi-year highs. So there's a confidence in the earnings power of these companies going forward that we haven't seen in years past. And so instead of being able to look at 1 year, they're looking at 2-3 years where they're booked up. That's a real statement of confidence from those management teams.
Interesting. What about the derivative plays to like industrial build out or power, like that kind of stuff, the ancillary ones, like is that still a real trade?
I think so. And when you talk about data centers, when we're talking about it, it's not direct investment in data centers, but it's the heating, the cooling, the componentry that goes into it. All those small widgets that no one can really name or identify unless you're the electrician, those are the things that can be very profitable, and those companies can generate a lot of cash flow. They're needed. And so when we talk about the data center demand being underestimated, those are guys who are all going to see that. And those are companies that are talking about seeing backlogs that are years past what their normal levels are.
All right, everyone's chasing the AI trade. And look, I get it. Money managers, they can't. It's hard to sort of go out on your own. You kind of have to follow the herd here. But there's got to be some investment ideas out there that aren't tied to AI in any way, shape, or form. Are there?
Absolutely.
Yeah.
There always are. And that's the beauty of having thousands of publicly traded stocks to choose from. And especially when you go globally as well. So remember, we've got a big universe to pull from here. I think what's important there is picking your spots. So there's some controversy in consumer. I like looking at consumer right now. I think that's an interesting play. We've got this
what part of the consumer, though?
General assumption that consumer is bifurcating. It definitely is. We've got the high end and the low end. Where are things going? But at the same time, you've got a cross current where we're still post-COVID with different consumer spending patterns and different patterns for what's important to people. So I think there's some stuff getting lost there in that cross current. There's some opportunities if you listen to managements, what products, what markets, and even what services. So when you think about this, maybe it's not just retail, but that flows into aerospace as well. We're seeing a really strong industrial aerospace cycle.
When you look at, well, is that tied to travel as well?
Absolutely.
Yeah.
So the more planes are in the air, the more they're flying, the more those components are needed. Again, it's that secondary supplier parts. Those are all in hot demand. We're seeing all the aerospace companies that came out and reported in their earnings, and the management teams talking now are talking about multi-year strength. And that's a good area, I think, to look in. That doesn't sound at all like AI, so it's been overlooked.
The MSC, is that what? Yeah, MSC Industrials on Friday, though, didn't report well. Fastenal also didn't. Those are the nuts and bolts. Like, they're super early cycle.
Right, but they're specific nuts and bolts. So those aren't nuts and bolts into data centers. Those certainly aren't nuts and bolts into aircraft. So it is a different element, but I think that is a shot across the bow for some parts of industrial, and that's where I think, this is my kind of market. You've got to be a stock picker here. You can't go across the board, and I love that because I think it does show you that there is some industrial weakness out there. Those are shadows that are coming, and so you want to listen really closely to what managements are talking about. People are starting to talk about a steeper back half of the year, the bigger earnings ramp they have to get up. Those aren't comforting words to an investor that likes to see things, moderately paced out. That means there's some hesitation. And when anybody talks about, we're really counting on the back half of the year, investors are going to step back and take a second look at that.
All right. Well, some people see a big rally coming in the back half of the year.
That's true.
If we're going to get to 6,000.
That's right. But it all depends on what you own.
Absolutely. Susan, great to have you here. Always great to get your insights. Susan Schmidt over at the State of Wisconsin Investment Board, helping us count down to the close. Just about 3 minutes to go here, Alex. And she seems very optimistic.
Yeah, but that was interesting. It's like the more you put on the back half, the more you have to be worried about the now.
Yeah.
That's such a good point because you're like, if it's what gives you the confidence to know that you've seen the trough and it's going to get a lot better in the back half.
That was the thing that was so interesting about Julian Emanuel's call too, right? Because I think a lot of people had predicted that the best was kind of behind us in terms of the rally. Not that we were going to fall off a cliff, but there wasn't much there left. He's predicting basically a 10% rally from where we are right now.
But is this just strategist capitulation? Is this what that is?
Well, not for him. I mean, he's been up there for a while now. Maybe for the rest here as he moves closer to those closing bells. Stick with us. We have a full breakdown of all of today's market coverage coming up next, right here on Bloomberg.
The Closing Bell, Bloomberg's comprehensive cross-platform coverage of the U.S. market close, starts right now.
And right now, we are 2 minutes away from the end of the trading day. Romaine Boston and Alex Steele here to help take you through the closing bell. A global simulcast afoot. Scarlett Fu joining us in the TV studio. Carol Masser and Tim Stenovic in the radio booth as we welcome our audiences across our Bloomberg platforms here on this record Monday afternoon.
What's
Carol
up with
Massey.
that? 30th record of the year for the S&P 500. I know we still have, a minute and a half to go, but pretty amazing that we continue to see that march higher and higher and higher. And it feels like all of Wall Street all of a sudden is like, I'm all in on U.S. stocks.
I thought it was going to be kind of a chill week. It is a holiday week. There's no trading on Wednesday, of course, the federal holiday of Juneteenth. But that's not actually what we're seeing today. We're seeing records on the NASDAQ Composite and the S&P 500, though we are off our highs on the S&P.
A chill, no-event week is still higher, right? That's the path of least resistance, although we should note that volume is down about 7% from the 20-day average, so it may be quieter, but again, when no one knows what to do, we just kind of levitate higher.
But we do have quad witching on Friday. We have S&P 500 rebalancing. You have the ETF rebalance as well. There was a great article by Lou Wang out that talked about the State Street Global Advisors needing to revamp its technology ETF and saying it's basically a buy NVIDIA, sell Apple, and that could be quite material. Like this is, $11 billion of NVIDIA shares to buy and dumping $12 billion of Apple. That's something.
All right. Also, we should point out, too, we are seeing an interesting reversal in the yield space here. About 6 basis points higher here on some of the key metrics in that space here. The dollar basically flat here on the day, and a big pop today in WTI crude, up about 2.5%. As we get the closing bells here in the U.S. equity market, you're looking at green across the screen and record highs for at least 2 of the major indices. The S&P 500 closing out the day higher by about 42 points, or about 0.8%, 54.73 and change as we wait for these numbers to settle. No matter where they settle, that's going to be a record high. The NASDAQ Composite up about 168 points or 1% on the day. The Dow Jones Industrial Average up almost 200 points or 0.5%. And the cyclicals trying to get in on the party as well. The Russell 2000, S&P 400 midcaps, and Dow Transports each up about 0.8%.
All right, so across the board, looking into the S&P 500, guys, most names, no surprise, higher in the Monday trade. 355 names gaining ground today, 147 to the downside, Scarlet, and about 1 unchanged.
And you look at the sector performances, look at the pie, that is the IMAP, and it's pretty much green across the board. There are 3 sectors in the red, utilities, REITs, and healthcare, but they are some of the smaller industries, so that's why it's not affecting the overall numbers. When it comes to best performers, consumer discretionary, which includes Tesla and Best Buy, Infotech, and of course that's Autodesk, and industrials, all gaining at least 1%.
That's a lot of green. Yeah, Tesla, a top name in both the S&P 500 and NASDAQ 100 today. Having said that, here are some of my individual gainers on this Monday. Autodesk, it's your number 1 gainer in both the S&P 500 and the NASDAQ 100, up about 6.5% for the trade. This is after Starboard Value said it's built a stake in Autodesk, valued at more than $500 million, plans to push for changes on the board because of concerns about the company's performance and how it handled an accounting probe. So investors certainly taking note of that one. Autodesk having the best day since November of 2022, so in quite a few years there. Broadcom also continuing its march higher, up another 5.5% in today's session. Number 2 gainer in both the S&P 500 and NASDAQ 100, all-time high. Analysts coming out, Melius analysts saying the company is the other AI stock, highlighting the AI revenue growth of 280% year over year, 35% quarter over quarter in the recent quarter. Up, this one, Broadcom, is up since it reported its strong earnings and its 10-for-1 stock split. It's up about 25% from that quarterly update. So we have just seen, I think, 7 days in a row that we've seen this one march higher. And one more for you outside the tech sector, Best Buy, but it's where you can buy kind of tech products, if you will, up about 4.6% in today's session. UBS raising the retailer to buy from neutral, citing several potential drivers for upside over the next 18 months, including an improvement in housing trends and appliance sales, as well as pending electronics replacement cycle. So again, Best Buy up 4.6%.
Okay, some of the gainers for you there. I got the decliners, starting with shares of First Solar, the worst performer in the S&P 500 on a percentage basis today, down 4.5%. We did see First Solar, along with other clean energy stocks, underperform. This as yields moved higher. Other interest rate sensitive asset classes also moved lower on the day today, extending a 3-day slide for solar and fuel cell stocks. Industry executives described challenges in the sector that certainly have to do with higher rates. As I mentioned, First Solar among the worst performers in the S&P 500, or the worst performer, I should say, in the S&P 500. Also, watching shares of GameStop, some actual fundamental news that moved the stock lower today, maybe, down 12%. The company did hold its annual meeting. We did hear from Ryan Cohen, the company's CEO. He did speak to investors. He said that he's focused on achieving profitability and plans to avoid the, quote, hype that has engulfed shares as part of the meme stock frenzy. Investors seem not to love that for some reason. Shares finished down by 12%, but they did fall as much as 17% intraday. And then Ovid Therapeutics just plunging today. Worst day ever, record low, fell as much as 77%, finishing the day down by 76%. The company did announce the failures of 2 late-stage studies of its lead asset for epilepsy licensed to Takeda. Laura Chico over at Wedbush called the failures disappointing, though she did say that she sees several near-term readouts that could restore momentum. Ovid, for its part, says that Takeda will move forward to discuss the totality of the data with regulatory authorities. The company does expect cash runway to at least last into the first half of 2026. Once again, Ovid Therapeutic shares down by 76% today.
I definitely didn't think there was a line in that chart for a second.
Didn't look like it, did it?
Because it's like basically a flat line at the bottom.
Yeah.
All right, guys, the bond market here, we're looking at a bit of a sell-off. Yields are higher, reversing about like half of the move that we saw since last Wednesday when we saw some really strong buying come in. The 10-year yield up by about 5 basis points. We also had some supply. You had Home Depot selling a $10 billion debt offering in 9 parts. So there was that kind of supply coming online. And also, maybe we were a little overbought at that point. We did have a really, really solid move. So moving a little higher there.
All right. Speaking of being higher, get ready, everybody, for the heat wave here in New York City and really across really a big swath, if you will, of the United States, especially when we're talking about the U.S. Northeast. We're also talking about, I think, across the plains. We're talking about 60 million Americans that are going to be dealing with some really record temperatures and a lot of heat. And that's going to put a lot of strain on individuals as well as a lot of systems.
It's not just New York City, which will reach 98 degrees by Friday in Central Park, but also other parts of the Northeast, including Concord, New Hampshire, could get up to 101 degrees on Thursday. We'll see scorching weather into Canada as well.
Yeah, but the other thing to keep in mind here is for a lot of kids on the East Coast, they're not done with the school year yet. Yeah. They're still in school until next week. Yep. So we're talking about being in school in a lot of places without air conditioning in 99-degree heat.
And Tim bikes to work. Tim, you're not biking to work this week, are you?
Yeah, you got to still bike to work,
That's insane.
We'll see. We'll see how it goes.
Also, they don't have showers here, dude. That's
I will
not
say,
cool.
To Scarlett's point, I don't think a lot of people outside of New York realize this, but a lot of New York City public schools don't have air conditioning.
Yeah.
Which is pretty wild to think about in this day and age. So yes, certainly the kids not having AC is an issue.
Yeah, this is why I pull my kids out of school. They're done for the year. I am curious. I mean, I know we're all focusing on this, but there was another story that caught my eye too, also involving New York City. I don't know if you ever tried to get a reservation at a fancy restaurant here in the city, but apparently if you don't know how to game the system, you're just not getting in. There was a great story here about people really reselling these restaurant reservations, and now I guess the potential that the government's going to clamp down on this, I don't know how.
They're going to clamp down, but anyone who wants a reservation and doesn't mind paying up for it will be able to get it regardless. It just kind of is bad news for you and me, Romaine.
Wait, I don't understand. Wait, how do we do this? Like, I get all the reservations and then I sell them to you guys?
That's exactly how it works. It's a great business
market.
idea.
It's like
you get something
tickets.
for free, and then you sell it to everyone. You win, Alex.
Market.
It's like bots, right? They buy up all the tickets, right? And then all of a sudden you're trying to get a ticket. There's nothing available and you've got to pay 4 or 5 times, what the original cost is. Apparently, it's not going to affect Resi and some other ones, Open Table and so on and so forth.
Really? Yeah, because they're not the problem. I got a little secret though that somebody pointed out. That I found out. I have to tell you off air.
Okay.
So actually, I just dropped Carol Mass's
Give us a
name.
hint. Come on.
Yeah, they say who's it for? I say Master, and they say, right this way, sir.
That's how it works.
What, at McDonald's?
That's the guarantee to get
exactly,
table
McDonald's.
anywhere.
But how much do these go for, you guys? You
Up to
$1,000?
$1,000 for
get
a
up to
table at one of these
$1,000.
hot restaurants.
But that's increasingly the norm now, where restaurants make you put down money when you make a reservation because it'll cost them to kind of save that table for you.
Yeah,
it prevents you from canceling at the last minute.
$25 or $50
ahead versus I'm paying Tim $1,000.
But if you have only 2 seatings per night, right?
And you're paying for the reservation, not for the actual food that you get as part of the reservation.
It's not even like before an appetizer hits the table, right?
I mean, I think if you're going to pony up $1,000, you're cool with it. Like, you're not going to really think too hard about that if you're going to, I don't know, Carbone and dropping $1,000 just for the reservation. These are not us, guys.
I was just going to say, you were going to say that. Like, it's not us.
It's not for us.
All right, guys.
Romaine's not saying anything.
Yeah, maybe it's for him.
Because it is Romaine. It is Romaine. All right, that is a wrap. Much love. We will see you again. Our cross-platform radio, TV, YouTube, Bloomberg Originals. We call it the closing bell. Folks, we will see you again, same time, same place, tomorrow.
Our coverage continues here on Bloomberg Television. Across asset, look at all the movers today, and the dollar, which is still wavering around its highs of the year. Carlos Fernandez Aller going to be joining us, the head of global FX and EM macro trading over at Bank of America Securities. This is The Close on Bloomberg.
Welcome back to The Close. I'm Scarlett Fu.
And I'm Romaine Bostick. Do we want to take a look at how the markets did today?
I have one word, high.
High, record high, to be clear on what Scarlett was talking about, not the other kind of high that she wants to talk about. 54.73 on the S&P 500, and that is indeed an all-time high, up about 0.8%. And of course, all the chatter today is about all those market strategists who think we can go even higher. The revisions continue here, whether it's 5,600, 5,700, or over at Evercore ISI, now talking about 6,000, Scarlett Fu, by the time we get to the end of the year. What leads that? I don't know if it's going to be GameStop, Microsoft, Nvidia, or maybe something else.
It's a little bit of catch-up to where the market has actually been the last couple of weeks and months. Let's take a look at some of the big movers on the day. We're going to start with Autodesk. It was the best performer in the S&P 500, led the tech sector higher as well after activist investor Starboard Value said it's built a $500 million stake in the software company and is pushing for changes to the board of directors. Now, on the flip side, also staying in the tech space is Adobe, losing 1.25% after the FTC sued the company, saying it violated consumer protection laws by making it too difficult for consumers to cancel their subscriptions. For example, Adobe allegedly did not adequately disclose that canceling in the first year will cost hundreds of dollars, and the cancellation process is unwieldy and long and complicated. Now, our top story for this hour is earnings, a new round of earnings in particular for home builders. Lennar reports today, while KB Home, which caters to first-time buyers, announces later this week. The group got a pop back in December when the Fed made its pivot towards eventual rate cuts, but that momentum has since faded. Fundamentally, we know demand for new homes remains strong, but affordability continues to be a problem. High prices and mortgage rates continue to discourage buyers. Romaine?
All right, Scarlett, let's take a look at the cross-asset moves here on the day, and specifically the U.S. dollar. Not much action here on the day, but it is still trading near a high for the year. It's been rallying after last week's Fed meeting reinforced the idea that rate cuts are still a bit off. Carlos Fernandez Aller joining us right now, head of global FX and EM macro trading at Bank of America Securities. All right, Carlos, we talk about the moves in the dollar. This has been a pretty good year for the dollar, no matter what happens next year. But there's a little bit of pause, it seems, for investors. I don't know. Are they focused more on what the Fed does next, or is there something else that'll drive this?
I think fundamentally, I'm still a believer on the dollar. And you still have a situation with very high growth, sticky inflation. Rates will continue high for longer. It's very difficult to see a way to fade this strength until you see proper cuts. And in our opinion, we are not going to see proper cuts until December. So in that respect, what I would expect is a summer of consolidation for the dollar, and then we'll wait whether, if there's a September surprise, then we may see fading of the dollar. Otherwise, again, it's a strong dollar environment, this one.
So you see this strength continuing. We have, obviously, that could be supported by monetary policy or the lack of change, could be supported by economic fundamentals as well. Is there any concern that you have that could maybe knock the dollar off of its perch?
I think the biggest surprise will be if the Fed, for whatever reason, they change the course and they start becoming more dovish. At the end of the day, what we are playing here is rate differential, and that's what is sustaining the dollar. I don't think that's my base case. This is definitely not my base case. If any reason the Fed goes dovish, then you may see a depreciation of the dollar, particularly because the overall feeling is that the dollar, from a pure fundamental point of view, is overvalued. So it's very important that monetary policy continues at this path for the dollar to continue performing.
How much of the dollar strength do you think is tied to this relentless rally that we see in U.S. stocks? We talked about Julian and Manuel of Evercore ISI seeing the S&P 500 getting to 6,000 by the end of the year. Citigroup is downgrading European stocks and upgrading U.S. stocks. Is that a key driver here?
It is a very important driver. At the end of the day, currencies are all a question of comparison. And at this point, the U.S. is the place to put the money. Maybe fixed income, equities, and you see that in the financial inflows that the market is experiencing. So it's definitely a factor.
as Japan started to make some comments about the yen, I'm wondering about the unwinding of the carry trade, because it's very much in the topic of conversation. And a successful carry trade needs two conditions, right? It needs rate divergence and it needs low volatility. Where are we with that?
So the thing about the carry trade, it was a very crowded position in that you can see, say for example, in emerging markets, you can go into currencies that pay you 11% nominal rates with inflation at 4%. Incredibly interesting. A lot of clients, a lot of the market was into the trade. 4 weeks ago, developed market volatility was trading above emerging market volatility. That almost never happens. That's a very strange market dynamic. But what happened? We saw last week elections in India, Mexico, South Africa, and it was a wake-up call that emerging markets are full of volatility. And we saw a correction in Mexican peso, which was the #1 carry trade of around 13% in a week, which for a currency is a huge correction. So the carry trade is still popular, but again, this was a wake-up call.
Well, let's stay in that part of the world, because the Mexican peso, the move that we saw in the peso was huge. Then we also saw some other big moves this year, also in Latin America. And I am curious, I understand volatility not always good, but is there opportunity to be found in Latin American FX?
I think it is. And there is quite a lot of reallocation. For example, Mexico, Brazil, we are seeing a trend of nearshoring from China into Latin America. And again, generally, central banks have done the work. We are trending to inflations below 4% with very high nominal rates. So absolutely, I think the opportunity is still in Latin America. Even Argentina, we are going to see positive real rates in Argentina. I don't even remember last time that happened. Yeah. So definitely there are opportunities. The problem will be positioning.
Just real quickly here, on Brazil here, we do have a central bank meeting in a couple of days here. Does that change what you see in the FX space this week?
They have to go incredibly dovish in order to change the overall dynamic. The story of Brazil is not just one of nominal rates, it's as well the trade balance has improved a lot. The general export power of Brazil is supporting the currency.
All right, great stuff. Carlos Fernandez Aller, thank you so much, head of global FX and EM macro trading at Bank of America Securities. And Romain teed it up for us perfectly, because we're going to focus now on Brazil. As he mentioned, the nation's central bank grappling with what some would call a self-inflicted crisis, a big central bank decision coming up. Joining us now is Bloomberg's Maria Eloisa Capurro. Great to speak with you, Maria. Can you just give us some context here? Take a step back and explain to us why Brazil's central bank seems to be in some kind of trouble.
Well, there's a lot at stake for Brazil at this week's rate decision, and that's because the bank is currently going through what many former central bankers are saying and describing to us as a credibility crisis. And we're seeing just that on market pricing, actually. If we're looking at break-evens, if we're looking at market expectation surveys conducted by the bank itself, it all points to investors pricing in price pressures that are above the bank's 3% inflation goal. And on top of that, we see that traders are already betting that there will be rate hikes later this year. So what we're seeing behind all of this pricing is doubts from investors about what's the bank's tolerance for inflation once President Luis Inácio Lula da Silva names a new governor later this year and effectively holds a majority of the board. But the reason why this is also a self-inflicted crisis, it's because it comes after a very controversial split vote that we saw last month, and that opposed all four board members appointed by President Lula, who wanted a bigger cut, to the majority led by Governor Roberto Campos Neto, who wanted a smaller cut, and that was effectively happened. So that 5-4 split vote that is very rare in Brazil was really shocking.
Well, Maria, I mean, particularly for foreign investors, it does raise a question here, and we talk about the self-inflicted wound. There's a perception among some folks who have questioned how independent the bank is at this stage. And I know we're kind of getting into an esoteric question here, but have they done damage to the image abroad?
Well, what we see right now is concerns and hiding doubts, and those doubts also have a root in Brazil's own history, right? Because prior to the country's last recession, many perceived that the bank was under political interference and was actually aiming for an inflation rate higher than its goal. So I think what investors are trying to answer is, will the past repeat itself? And that's why it's very important what central bankers do this week, not just their decision, but the votes and the statement and the wording from the statement is something that investors are going to be really looking into.
Okay, so Maria, you have traders betting that the central bank will soon need to raise rates because of inflation, yet there's this push, there's tension from the other side. Are we actually expecting the central bank to do so, to go forward with tightening policy?
Well, central bankers have said nothing about hiking rates, but given the rise in future bets of inflation and other economic indicators, it is very likely that they will pause their almost year-long cycle of cutting rates this year. And that is very likely to infuriate some at the government. We have to remember that President Lula has been very critical of the bank. We've seen him this week going back to his calls for lowering borrowing costs. This is a president who has argued also for a higher inflation goal, repeatedly singled out Governor Campos Neto. So a decision to pause the rate cuts is likely to heighten those tensions on the political front.
And explain to just the communication that is coming out of the bank and that could come out of the bank this week. I mean, here in the U.S., I mean, we kind of deal with the problem of over-communication by Fed members here. What is that? What does that communication look like in Brazil?
Well, so far, central bankers have said that their last split vote was basically focused on divergences of a change of guidance that was decided by Governor Campos Neto, and that we later found out that wasn't fully discussed among members of the board. And they have, since that split vote, been reiterating their commitment to their inflation goal and saying that there's a consensus on their economic analysis. But we'll have to see exactly what that vote is and what the statement is. So far, I've talked to analysts who doubt that there will be an unanimous vote. But as former central bankers have told us, that consensus, that unanimity on the vote would be crucial to restore that credibility at the bank.
All right, Maria, great stuff. Maria Eloisa Capurro there down in Brasilia here. A closer look here at the Brazilian real and, of course, a big central bank meeting, Scarlett, on Wednesday of this week.
Yeah, that's right. I was just looking on the Bloomberg. You can go and look at central bank action. And yes, we have the rate decision on Wednesday and the rate decision again on July 31st. But in terms of actual central bank speeches that are scheduled, I only see something about everyone speaking in Sintra on July 2nd. You contrast that with the U.S. You have 6 Fed speakers tomorrow on the calendar.
Tomorrow. 6. And my guess is half of those 6 will probably speak again at some point later this week.
Absolutely.
Crazy
Twice in 1 week.
times we live in, Scarlett Fu. And guess what? We're going to cover it all.
Absolutely. All right, the top 3 is coming up, where we focus in on the top 3 movers and shakers at the center of the day's big stories. This is Bloomberg. It's time now for the top 3, where we name drop the people driving some of the day's most talked about stories. And first up is Vivek Murthy, the U.S. Surgeon General, calling for a warning label on social media. In a New York Times op-ed, he wrote, quote, "A Surgeon General's warning label, which requires congressional action, would regularly remind parents and adolescents that social media has not been proved safe." He says that adolescents spend an average 4.8 hours on social media a day.
How exactly is this going to work, though? I mean, I don't think anyone disagrees with them, or at least no sane person disagrees with them. But putting warning label, is that going to have a real effect? And where do those warning labels pop up?
I know.
Are they going to pop up for me, the parent? Because if my kid sees it, he's just going to ignore it.
Yeah.
Okay, but can he do that himself, or does he need me to come into the room and do it for him?
No, that's a good point. These are all open questions. Nevertheless, there's no actual legislation on the table to put a label on social media in Washington.
All right, I'm keeping an eye on Bob Iger, the CEO at Disney, actually having a pretty good weekend, or at least one of his films is Pixar's Inside Out, grossing $155 million in the U.S. and Canada. That's the biggest opening weekend here in North America so far this year.
Yeah, and the best debut since Barbie, which made $162 million as well.
Yeah, and I'm not too surprised, right? I mean, I feel like anytime you have these animated movies, these kids movies, they tend to get more traction than the adult films like an Oppenheimer or Barbie.
Well, yes, it appeals to both. It appeals to both the kids and the parents. It's really crafted towards both of them.
And by appeal, I mean the parents are forced to go.
Yes, absolutely.
Okay,
yes, for sure. All right, the third person I'm watching is Angelina Jolie. She won her first Tony Award for producing The Outsiders musical.
Oh, yeah?
She's now halfway to EGOT status.
Halfway to EGOT. So what does she have? She's got a
Oscar
and a Tony. A Grammy?
She needs an Emmy and a Grammy. Don't know.
Okay.
Open question. All right, Lennar earnings expected any minute. We'll be breaking it down for you. This is The Close. All right, we have Lennar earnings just crossing right now. This is a home builder, and this is for the second quarter, the March through May quarter. Second quarter revenue, $8.77 billion, higher than what analysts had anticipated, which was $8.57 billion. EPS of $3.45, also higher than what was anticipated of $3.01. As for third quarter deliveries, Lennar sees 20,500 to 21,000. That is just shy on the high end of what analysts were looking for, which was 21,004. So as a result, the stock has been bouncing around a little bit here, currently somewhat lower in the after hours trade. Really, the focus is on what the orders look like because mortgage rates have been all over the place in the March to May quarter. I was checking, they were at a low of 7.02% and a high of 7.56%.
Yeah, it's kind of interesting because everyone talks about sort of the real sort of ballast for this part of the industry is the idea that we do have this housing shortage. But then I look at the most recent numbers here and you look at that backlog, still a healthy backlog, 17,873, but that's down 12% year over year and below what the street was looking for.
All right, let's bring in Patrick Clark to give us a little more context here on Lennar and the other home builders. We know that KB Home will be reporting later on in this week. What is the big story here with the home builders? Because mortgage rates are certainly a source of concern because there's this perception that there's a lack of affordability. And of course, high home prices in general contribute to that as well. So home builders are in this position where they have to provide incentives.
That's right, but I think things set up very well for the home builders, especially the very big ones like Lennar that have finance companies that are able to buy down rates for home buyers and can make a monthly payment a lot more affordable for a new home than it is for an existing home. 7% mortgage rate versus 7.5% mortgage rate. Either case, it is relatively high historically and very high when you consider the price of home. So the combination of the home cost and the mortgage rate. And
what type of, I mean, we talked a lot about how these home builders were offering a lot of incentives, particularly as we saw those interest rates go up, ways to sort of keep those home buyers in the mix and to feel a little bit better about paying whatever, 6, 7, in some cases 8% here, offset by some of those incentives here. Are we still seeing them hold those incentives or have they kind of moved on?
No, I think they're still doing it, and I think it's still valuable. I mean, it's again, you can see it in the the existing home sales numbers, which will have new data later this week, I think.
Yeah.
I mean, we're taking her along at like just over annual pace of just over 4 million, which is like that's where it was in spring of 2020 when people were sliding contracts under their lawyers' doors because like that's how you had to transact, and that's where we are today. So there's still a big opportunity for them to to entice buyers by helping on rate.
Is there still a spring selling season? I mean, once upon a time, that used to be a really big deal. But now people are there's a lack of inventory, right? And people are just trying to buy as soon as they can find something. So how much activity is there really during this period?
I mean, you can see it in the numbers. There's not a lot of it, right? It's on hiatus at least, right? I mean, I think there's some signs
like the congestion pricing plan on...
Yes, sure. I guess it's like that.
All right. Patrick, thank you so much. Of course, we are awaiting KB Home's results later on in the week. Lennar second quarter adjusted EPS, $3.38. Analysts were looking for $3.24. We'll see how it all shakes out later on when they hold a conference call. But it was a record day for stocks overall.
Yeah, and we should point out the home builders have been on a record run, too, particularly with Lennar, Toll, and some of the others here. So even if you're getting this pullback in after-hours trading, I don't know if the bloom comes off the rose. Again, this is just really just basic, the most basic of supply-demand dynamics here. I mean, Econ 101 here. And the fact is there just aren't enough homes to go around. So if you're making them, I guess in theory that gives you the upper hand.
Absolutely. Yeah. We also should mention there was a sell-off across the curve in treasuries. There was 19 investment-grade corporate credit deals that came to market, and that increased supply means that people need to make room in their portfolio to buy the deals. And I'm also looking at ICLN. Oh, you know what? We don't have that here, but crude oil up by 2.6%. That is a perennial source of inflationary concern. And worth noting, the dollar, even though it's near year-to-date highs, not doing a whole lot at the moment.
Yeah, keep an eye on that crude move here. We didn't talk a lot about much on the program here, but one of the biggest one-day upticks that we've seen in several weeks here. We'll get back to that in a second. A lot more coming up here on the show. When we return, we're going to take a closer look at international trade and the legislation that led to some of the highest U.S. tariffs on foreign imports ever. That's coming up next here on The Close on Bloomberg. All right, it was on this day, June 17th, 1930, U.S. President Herbert Hoover signing into law the Smoot-Hawley Tariff Act, one of the most controversial trade policies in world history. The legislation increased tariffs on roughly 40% of the goods coming into the U.S., as much as to 59%. Extra import taxes that ostensibly were intended to protect U.S. jobs. Now, while Calvin Coolidge, the former president known for pro-business policies, praised the tariffs for securing the American market for the products of the American workmen, there was an almost unanimous plea by economists at the time not to pass the Smoot-Hawley Act. Walter Lippmann, the country's preeminent columnist at the time, calling it a wretched and mischievous product of stupidity and greed. Even the U.S. Senate, on its official website today, calls Smoot-Hawley among the most catastrophic acts in congressional history. That's a quote. To understand that catastrophe, you have to remember that back in the 1920s, that was a golden age for the U.S. economy. GDP was growing at a 5% rate in real terms from 1921 to 1929. But that prosperity, it was brought to an end by several policy missteps, including those tariffs that ultimately made the U.S. consumer poorer and foreign exporters angrier. Foreign governments retaliated with their own tariffs, and that exacerbated U.S. inflation. It contributed to the Great Depression, and it cost President Herbert Hoover his re-election campaign just 2 years later. Now, with 94 years past and with 5 months before the next presidential election, tariffs and their effects are back in the spotlight. Current President Joe Biden, building on his predecessor's levies on Chinese imports, saying back in May that China's industrial and trade policies are putting U.S. competitors at a disadvantage, and the only remedy was higher tariffs. Now, some of those key changes do kick in this year and next. That includes a 25% tariff slapped on critical minerals like cobalt and zinc, a doubling of tariffs on Chinese chips all the way up to 50%, a tripling of tariffs on steel and aluminum to 25%, and a quadrupling to 100% for tariffs made on Chinese-made electric vehicles.
And let's follow on that, because clearly tariffs a big issue in the U.S. presidential campaign, with both candidates pledging to protect U.S. industry from Chinese competition. As Romaine mentioned, the White House announcing 100% tariffs on EVs made in China, even as it pushes for an accelerated transition to clean energy. You look at EV prices in the U.S., they're falling fast, but they're still a lot more expensive than what's available in other countries right now. So let's bring in Jon McNeill. He is CEO and co-founder of the venture capital firm DVX Ventures. He knows a thing or two about EVs and national policy. Jon sits on GM's board of directors. He is the former CEO of Lyft, and he's also a former president of Tesla. Jon, it is so good to speak with you. Romaine set it up for us perfectly, and I'm curious to hear from you. How much does 100% tariffs on Chinese-made EVs complicate Biden's goal of 50% of all new car sales to be electric by 2030?
I think, EVs, well, and autos in general, if you look at the automotive industry, it's about 5% of GDP. So it's a big deal. And we want that industry in the U.S., I think, to remain at the forefront of technology and productivity. And as part of that, we need to remain competitive. And we're dealing with much more sophisticated actors now with nation states than we were in the 1920s. And China's been really diligent about choosing industries that they want to learn and then really excel. And one of those is EVs. And so they've subsidized factories, they've subsidized components and labor and technology. And we find ourselves now competing very hard for one of the biggest chunks of our GDP, which is autos. And so I think as part of this policy, the real purpose of the policy is to give American EV makers a chance to really come down the cost curve to compete effectively. And the American manufacturers are working very hard at that, but they do need time to become cost competitive. We're seeing just some of the initial signals of that. Just this quarter, Chevy is releasing the Equinox, which is a 311-mile compact utility vehicle that some people are calling the perfect car, and it's $27,000 and change after the tax credit.
I am curious, though, on that pricing, whether it's some of these newer models coming out or some of the ones that we're seeing overseas where they have sort of found that affordable pricing model. Does that actually mean, though, that their costs are in line with that pricing? Because there's been so much talk about how much money these companies lose on each EV that rolls off the lot.
Yeah, I think for the upstarts, you've got companies that are bearing the full cost of new factories, and so they do lose an enormous amount of money per car. But if you look at the guidance, for instance, that GM gave, they gave guidance that they'll be profit neutral in their EVs to profit positive towards the end of this year. So that means the answer to your question, Romain, is yes, the costs are falling in line with these new price levels.
I'm curious also, you said the U.S. needs to compete on the cost curve, but there needs to be consistency of policy in order to achieve that. And you have, for instance, oil and ethanol industry groups suing to block new air pollution limits issued by the EPA. People are pushing back against the Biden administration. And in fact, former President Trump has also said that if he were to win the election, he would entirely reverse Joe Biden's EV policy. As an automaker, how do you plan ahead for this?
I think, you've got to plan for all scenarios. And I think Elon said it well in the shareholder meeting, the Tesla shareholder meeting the other day. He was essentially asking for a level playing field. And he said he'd be willing to give up all EV policy subsidies if the oil industry got rid of all of their policies, their subsidies as well. And so I think both of those things are super important to consider.
I am curious about kind of the broader ecosystem here, Jon, as we sort of talk about EV adoption and the race to a cheaper EV, or at least a more accessible one, I should say. There's also a lot of questions about charging infrastructure, maintenance infrastructure, a lot of things that, at least for Tesla, if you were a Tesla owner, they got right. But of course, we know a lot of that didn't transfer to other vehicles here. Are we going to get that right this time around?
Yeah, I think we're looking specifically at our venture firm, we're looking at all the second order effects of EVs. And you mentioned a couple of them. One is charging infrastructure. We, quite frankly, need a lot more charging, and it needs to go at a faster pace. The second you mentioned is maintenance. EVs allow you to maintain a car mobile with mobile service. And as you mentioned, Tesla pioneered that, but we've actually now got a company out in market, Kirby, that is allowing and enabling car dealers to look like Tesla with mobile service capabilities and really servicing not only the EV customer, but the gas car customer as well. And then there are other second order effects like battery recycling and the connection to the renewable grid that these EVs allow, that I think you're going to see a lot of investment activity in those four areas over the coming couple of years.
I am curious about the recycling side of this. There has been a lot of talk. I'm not sure how informed the talk is, but there's been a lot of talk about kind of what happens to these cars and their components once the user, the owner, gives it up here. Do we have that sort of, I guess, recycling infrastructure in place, or is that something that still needs to be built out, where once these cars are done with, we can dismantle them and recycle the parts in, I guess, a reliable way?
One of the cool things about an electric car battery is at the end of life, you can take it out, peel it back, and those minerals that went into the original battery are totally reusable. They don't degrade. So the magnesium, the nickel, et cetera. The only thing that degrades is the lithium hydroxide. It actually turns into sand over time. So you can pull out all the rare earth and key minerals and recycle that into a new battery. That's happening right now. I think Tesla announced last week that a significant number of their Model 3s that are produced have actually been produced with a recycled battery.
Thanks for explaining that. I had no idea about that part about the lithium turning into sand. As we've made clear, China has an advantage here when it comes to EVs, right? It has the supply chain advantage. It has national support through subsidies. What advantage does the U.S. EV industry have, if any?
Hey, we've got an incredible advantage in the software side of these EVs, which as vehicles become more and more software defined, we've got a real advantage. The other thing that the U.S. companies are really, really good at is scale manufacturing. And lastly, the ride quality and experience. And so what the U.S. manufacturers are able to do is bring a really high-end ride quality down into a car that's priced in the $20,000 range. And that will enable us to compete well. But as you said, we've got to bring the supply chain over to the U.S., and that's what policymakers are working really hard to do within not only the car industry, but the chip industry, so that we get not only the manufacturing capability of EVs, but we get the supply chain to follow that as well.
All right, and then DVX, of course, trying to do its part as well. John, got to get you back here to talk about some more of your portfolio companies. Always appreciate your insights. Jon McNeill, the CEO and co-founder of the venture capital firm DVX Ventures, and of course, a long history in the automotive industry, including his roles at Tesla and GM.
Do you have an EV or have you driven one?
No. Well, yeah, we went through the whole couple years ago. We were going to buy one. We basically test drove every single EV that was on the market at the time. Ultimately, we didn't buy one. And you know why? A, they were very expensive relative to some of the ICE vehicles or the hybrids. And we were concerned about charging infrastructure because we decided we didn't want a Tesla. And unfortunately, everything in our neighborhood, they were Tesla-only chargers. I know they since made a deal with like Ford and a couple others that allows you to use them. But at the time, we had no other option.
Yeah, you just look at what the experience is like when you rent an EV and the difficulty of finding a charging station as you have to return it. And then you end up having to pay the extra fee on top of that. So it's just an extra level of stress.
Yeah. So what do you drive? Like a F-350 or something like that? Yeah.
Gas guzzler.
All right. We got to go here, but stick around. When we come back, we're going to set you up for what to watch tomorrow. This is Bloomberg. The next big U.S. economic data point comes tomorrow with retail sales, 8:30 a.m. Washington time. The headline number expected to modestly rebound to 0.3% after flat growth the previous month. Shannon Grein joining us right now, economist over at Wells Fargo. And Shannon, let's get right to it here. I guess we're going to see a rebound here on that month-to-month basis here. Is that indicative of broader trends?
Yeah, so I think what you're going to see tomorrow is pretty much a continuation of what we've seen in recent months, where you have some volatility under the surface of the headline print. So we'll be paying very close attention to the control group measure, which excludes some volatile categories that the BEA measures in other ways, like autos and things of that nature, to try and gauge the second quarter data. But I think you have a consumer at the end of the day who's demonstrating this underlying resilience and activity, and we expect that to show up in terms of retail sales for May.
Okay, so underlying resilience, but what will you be looking for from the report that would give us some clue as to how the consumer is likely to spend in the months ahead?
So I think we're going to be paying close attention to the sales categories at a retailer level. So what's happening across different types of goods in terms of retail sales. So retail sales mostly covers goods spending, which obviously isn't the whole picture in terms of the consumer. And for the first quarter, we did see a significant pullback in durables. So we're expecting somewhat of a rebound in autos, which is a large component. Then we'll also be looking at other interest rate sensitive categories like furniture, appliances, see if tighter policy is really weighing on consumers as it has in recent months. And then we'll also be paying a close attention to that food services or restaurants component, as it does give us the leading indication of the services side. So I think paying close attention to the details for tomorrow's release will be really key as we think of how consumer momentum is really faring through the second quarter.
For a lot of those folks trying to look for, I guess, the canary in the coal mine, whether you're looking at credit card data, delinquency data, and just overall loan level rates here, anything of concern there, Shannon?
So I think most of the consumer fundamentals are consistent with the moderation to be had or to come, right? So you mentioned delinquencies, loan data. You have the personal saving rate remaining at low levels, excess liquidity really having dried up here, real disposable income growth is slowing. So a lot of the fundamentals position for a slowdown in the consumer, but we just haven't really seen that translate to the spending data as of yet. So I think these retail sales data, the consumer personal income and spending report later this month are really key, particularly even in the context of the Fed as they assess how the macro conditions are evolving. So we overall look for a moderation in spending this year just based on those slow fundamentals. I don't know if we're going to see that to a great extent into tomorrow's data, but I think you're going to keep seeing that gradually show up in the consumer data as a lot of those fundamentals are weaker than they have been and are consistent with a more moderate pace of growth in the second half of the year.
Okay, that gives us a sense of the trajectory that we might anticipate in the second half of the year. I know that some schools are still in session right now, but at some point the parents and families will be going out to spend for back to school. How do you anticipate that to play out this year?
So the back to school dynamic and other holidays or annual shopping sprees, if you want to refer to them that way, are typically accounted for in the data. So they're going to be accounted for in terms of the seasonals. If it's a better or worse expectation than what the seasonal is accounting for, you could see it show up in the data. I think it's a little early to see kind of what's going to happen in terms of going into September. But I don't expect it to be a blowout or a complete miss at this point. I think you have a household sector that's continuing to spend at a relatively decent pace. And even though they had transitioned more towards services and less towards goods purchases over the past year, I think you're seeing a little bit of a more normalization in terms of that balance, where goods purchases are remaining at a decent clip, even as services activity has remained robust going into the summer months. So back to school will be a good indication, I think, going into the fall and the end of the year, but it should be accounted for the most part in a lot of those seasonal adjustments.
All right, Shannon, great stuff. Shannon Grein there over at Wells Fargo. A closer look at that retail sales report, Scarlett, out at 8:30 a.m. Washington time tomorrow. A bit of a rebound expected.
Yeah, I'm really curious as to see the back to school shopping, because we know retailers like Target have already cut prices on about 1,500 items, and they've made clear that they're going to do so in the months to come, really gearing up for that burst of spending before the school year starts.
All right, retail sales on tap. Also, what to watch over the next 24 hours. We're going to get industrial production numbers as well. That comes out at 9:15 a.m. Washington time. And Scarlett, your favorite. We're going to get a lot of Fed speak tomorrow.
A lot of Fed speak. I mean, I lost count after 5. It's 6 Fed speakers, different Fed speakers tomorrow throughout the day. Austin Goolsbee, Dallas Fed President Lori Logan, St. Louis Fed President Alberto Muslim. And then you've got a couple of them repeating later on in the week as well. So plenty of Fed speak to dissect.
Also some events going on Capitol Hill. The CEO of Boeing, outgoing CEO, we should say, Dave Calhoun, scheduled to testify before a Senate subcommittee.
Yeah, he's expected to tell Congress that the company hears the safety concerns that everyone has. It hears it loud and clear. That's part of his prepared testimony. I don't know how many times he's going to have to say this before Congress believes him, or the public believes him for that matter.
Yeah, also we have an exclusive interview coming tomorrow with the CFO over at Citi. Mark Mason going to be sitting down with us right here on Bloomberg Television.
Yeah, looking forward to that conversation. Be sure to tune in at 2:15 p.m. Eastern time. And there's still earnings.
Yeah, we still get earnings. KB Home scheduled to report, maybe a bit of a continuation of what we got out of Lennar today, and Vladimir Putin scheduled to visit North Korea and Vietnam. A lot of events to keep an eye on that could potentially move the markets. Scarlett and I will be back tomorrow with all your market coverage right here on The Close on Bloomberg.